A very good evening to all of you students. Kiran, Harmisha, Ajay, Divya, Sahil, Bhumika, Hardik. Very good evening. My name is CA Divas Gupta, and we will be discussing on the topic of dividend decisions in today's and tomorrow's session. So, yeah, students, in in any financial decisions, there are three primary decisions that any company's management has to take. The first one being the financing decisions. In financing decisions, the companies decide which source of funds to be used, whether in the form of debt, whether in the form of equity, whether in the form of a mix of debt or equity or any other instrument. Kadambri, Manohar, Sushil, Mamta, Shweta, Mansi, Tanishka, Ninad, Anmol. Good evening. So, in financing decisions, the management is trying to ascertain that what is the right source of finance, how much is to be raised from that source, and what would be the cost of raising or cost of obtaining those funds, right? So, these are the typical factors that management will consider while deciding about the financing decisions, apart from the risk factors too. Gajendra, Anindita, good evening. Second type of decisions are investing decisions. So students, now if you see, we have decided that from which source we have to fund the requirement, we also need to understand where to invest. Now in investing decisions, you would be studying, or I think you would have already studied the capital budgeting. Capital budgeting is one such topic which helps us in deciding what is the right form of investment, whether to invest or not, through calculating the NPVs, through calculating the payback periods, IRR, and all those things. Okay. So, second crucial decision from the management side of a company operating is an investing decision. And the third category of decisions are actually dividend decisions. Now you source the funds, you invest them in some of the other proposal, and then you arrive at the revenue. Then you arrive at the revenue, you make your P&L, then you are left with some profits. Now, the decision making is that what will you do with those profits? Will you again invest it back, or will you pay it as a dividend? This is a very, very important and practical topic, because the way companies also decide today, while we will go through the topic in these two sessions, we will come to know what are the factors that companies takes into account while thinking or while deciding whether to pay a dividend or not. So dividend decision, students, is all about taking a decision whether to pay a dividend or not to pay a dividend. If yes to pay a dividend, how much dividend will be paid? Okay. Now, let's take our discussion on dividend decisions ahead. In case of dividend decisions, students, please imagine that there is a company which has, let's say, some of the assets and some of the equities and liabilities. I'm just putting it in a T form, okay? Avinash, Basavraju, Prashant. Good evening, everyone. Gunjan. Okay, Gunjan, let me check. Srinivasan. Sir, first we need to check the investment opportunity, and after that we need to check the financing decision. Why financing prioritized first? No, Srinivasan, I'm not saying that financing is prioritized first. I'm just saying that one form of decision is financing, second is investing. I'm not saying it is sequence. I'm not saying that it is a sequential thing. Okay, Srinivasan? I'm I'm clubbing the type of decisions into one. Okay. Now investing can be first, then can be financing. However, if you are already having funds, then investing you will have to decide, right? Lokesh, good evening. Okay. Now, in case of dividend decisions, uh, as I'm telling you that imagine that there is a balance sheet of a company where there are some assets and there are some equities and liabilities. What are those assets, students? There can be, let's say, property, plant, and equipment in their balance sheet. There can be, let's say, trade receivables, right? There can be inventories, there cash and cash equivalents, correct? Good evening, Anirudh. In the form of liabilities or equity capital, there will be, let's say, share capital, there will be reserves and surplus, there will be trade payables, or there can be other current liabilities, non-current liabilities, whatever it may be, right? I have just plotted some of the things. So if you see, students, generally these reserves and surplus, whatever they are representing for the current year, within this reserves and surplus, there will be some amount that will be sitting for the current year, whatever they have earned. That generally is sitting in cash and cash equivalents, right? Because the decision is yet to be taken. So we are saying, let's say after the year end, company has earned 1,000 crore rupees. That's the profit for year. Now, with this profit for the year, till now the company has not decided what to be done. So it is still resting in the form of cash and cash equivalents, right? Now the company will decide whether this 1,000 crore needs to be retained or it needs to be paid. If it is paid, it will be paid in the form of a dividend to the share capital owners. If it is retained, it will be invested back in the business. Vijay Raghavan, good evening. Anirudh, good evening. Okay. I hope this situation is clear. Now, we also need to understand, I'm just, as of now, throwing some light on what is the context of this topic. Okay. And this is going to be a very big decision, students. Now, suppose the management thinks that if they don't distribute this 1,000 crores, then in the share market, the shareholders might feel that the company is not paying dividend and hence it might impact their market capitalization. Or they also feel that it has to be retained because they're coming up with a very big project next year for which they need funds. If they pay dividend now, they will have to do a borrowing later on. And doing a borrowing, again, this will go back to the financing decision now, right? Now, while doing the borrowing, it will increase the risk of the company, risk of non-payment, risk of delayed payment, and it will also involve cost, which is interest. So Harmisha is saying every time profit will not be in cash, there will be some non-cash items. Yes, Harmisha, I agree. Hence, I'm saying that whatever is the non-cash items, you ignore them. So I'm saying broadly, whatever you earn, you will end up getting in your cash flow from operations. And it will be sitting in the form of cash and cash equivalents. Okay. Okay. Just for the discussion sake, I'm saying practically the cash flow from operations is, yes, totally different from the net profit that we arrive. Okay. Now, coming to the next part, dividend can be settled in two forms. One in the form of cash outflow. Okay. By cash outflow, what do we mean? That from the balance sheet, reserves and surplus will be reduced and cash and cash equivalent will also be reduced. Let's say from bank it will go and it will also hit the reserves and surplus, right? Mohammed, better you can maintain the notes. I'm not sure whether we can upload it or not. Better to take notes, right? Perfect. So that's what I was trying to say, that dividend can be paid in the form of cash outflow. Cash outflow will reduce both the sides of the balance sheet and your balance sheet will become slightly lesser, right? Or the second form can be in the form of bonus shares. So this cash outflow, students, will be in the form of a warrant, ECS, right? Or check, correct? Or let's say an online transfer. Bonus shares is actually, let's say, issuing one bonus share on 10 existing share. Let's say the ratio is 1:10. So for every 10 equity shares being held, one bonus share will be issued. There can be third form also in the form of equity. Can anyone try this? What will be the third form of paying a dividend? How will companies better be able to pay back the money? The third form is equity buyback. Now, what company does is that they will buy back the equity shares at a very high value, denoting, and not the 100% amount. It will, let's say they will buy back 20% of the amounts, 20% of the holdings of all the shareholders, right? Okay. In that case, what will happen? They will end up paying higher amount and that will go as dividend. Okay. Yes, Anmol. Manish. Rights issue, Gajendra, will come at the exercise price. Correct? So still we will be realizing something in case of a rights issue. Shweta, you are right. Bonus. Harmisha, you are also right. Nikita, you are right. Sania, adjusting against unpaid amount of shares. No, Sania. Whatever is the unpaid amount of call that company has to call, right? That company cannot adjust against that. Yes, Shweta, buyback. Perfect. Okay. So just keep these things in mind. Now, let me give you a situation wherein I am saying that 100 crores per annum on last 5 years average, the company is making. Okay. On an average for the last 5 years, 100 crores per annum, the company is making as profits. So these are steady profits, right? There is no up and down. There are no different business cycles. Now, out of that, let's say 80% company have been paying as per the policy as dividend. Now, in current year, what happens? Current year, suddenly there is a 400 crore abnormal gain. Due to such abnormal gain, the overall profitability becomes 500 crore. Yes, Harish, you're right. Gunjan, right issue will be a financing decision. Okay. Srinivasan, so dividend will reduce share price, but buyback increases share price, then how dividend is equivalent to buyback? I will come to that, Srinivasan. Let's first focus here. Okay. So this increases to 500 crore. Now you you understand the dilemma of management again. They will say that we have a one-time gain sitting in our P&L. Now, what to do with it? Should we again adopt a 80-20% policy on 500 crore, or let's keep this 400 crore aside and only on 100 crore we can pay the 80-20? Because if today we pay on the entire 500, next year also shareholders will assume that on entire 500 crore, the amount should come. Correct? So these are some of the problems that these management faces. So I'm just trying to bring out some of the problem statement, students. Okay. Now coming to your question, Srinivasan. Sir, dividend will reduce the share price, but buyback increases the share price. Okay, Srinivasan. First of all, let us not think on a standalone basis. Let us think from the overall holding perspective. So let's say I am holding, or let's say Mr. A is holding 100 shares. Okay. Mr. A is holding 100 shares. The equity buyback plan, which says that the company will buy back 20% of 100 shares, okay, at the rate which is higher than the market value. Let's say at the rate 50% higher than the price that is operating in the market. So what will happen? Mr. A will have to retain 80 shares, but for 20 equivalent shares, Mr. A will get 50% higher amount, right? So Mr. A will end up getting dividend for this higher 50% amount. Okay. Now, whatever happens after this equity buyback, that's a separate story that we will discuss later on. Okay. Yes, we will come to constant dividend. Parth Sarthi, we will come to that. Okay. Okay, students. I hope this is clear till now. Now, the next part is significance of dividend policy. Okay. I'm just going in the sequence. Some of these topics are given in the study material. Okay. We will first discuss the concepts and then we will do a questions. The assignment is already uploaded, students. We will be doing questions basis those assignments. Okay. Now, significance of dividend policy. First part is long-term financing decision. So here we say that, so Pooja is asking what is ECS? Sorry, ECS is one electronic form of transferring the funds. Okay. Long-term financing decision is, so sorry, we are studying about the significance of dividend policy. Under that, we are saying that there is a long-term financing decision that we have to take. Now, under a dividend decision, if we decide not to pay any dividend, we will end up investing it back. So is it one form of financing? Yes, it is one form of financing. So hence we say that for the long-term financing decisions, it is very much relevant for us to determine what is the dividend policy. Hence, there is a significance of dividend policy on long-term financing decisions. Now, what are those underlying factors? Students, there are two things that we need to understand in this parlance. One is the return on investment, which is called as ROI, and second is cost of equity, which is also called as KE, this ROI is also denoted as R. Now, can any one of you tell me what what does what both of these terms signify? Or what is the difference between ROI and cost of equity? I request everyone to please attempt this and share your thoughts on this. What do you think would return on investment mean? And what do you think cost of equity will mean? Come on, students. Very nice. I am getting a lot of answers. So Bhumika is saying returns expected by shareholders. Very nice. Akshay is saying ROI is what the company gets, but cost of equity is what it pays. Okay. P. Sai Dheeraj is saying, Sir, K is the dividend paid to the shareholders. Okay. Rajneesh Singh, cost of equity is acquired cost. However, ROI is referred to the return, what we get on investment. Very nice. Harmisha is saying ROI means when we invest in any plan and percentage of return we get from it. Nice. Anmol, K is equal to expectation of capital provider. Very good, Anmol. Ninad Desai is saying return on investment is what you get when you invest in any share. Okay. Manish is saying ROI is internal return company is earning KE, return company is expected to provide. Okay. Nice. I think all of you are having the correct thought process. Kiran, cost of equity is cost to company. Akshay, ROI is inflow, K is outflow. Okay. Harish, ROI should be higher than KE. No, Harish, it can be lower also. So that thing we will discuss. Basav Raju is saying dividend or interest for ROI. Okay. Shweta, ROI is the net profit for equity shareholders. No, ROI is not net profit. Sanya, ROI includes earnings for preference shares also. I might not agree to that as well, Sanya. Mamta is saying ROI, dividend or returns on investment, which is getting for investing capital. Yes. Nina, the cost of the amount of shareholder has to pay. Return on investment is from shareholder, but cost, yes. Nikita Kamal, cost of equity shareholder, yes. Harish, Shweta, Avinash. Manohar, cost of equity, just like how much we pay dividend or ROI is just okay. Srirang, thanks a lot everyone for answering, students. Now let me clarify. I think almost all of you are correct. Just hear me out. So return on investment, students, is return on investments is the return that the company gets on the investment that the company has done. Okay. So it is the return generated by the company's operations. Let's say the company is into the manufacturing of tires. The company manufactures tires and sells it. The company makes a profit. And there is an investment involved in the business of tires. Let's say the investment is again 1,000 crore. Okay. And on that 1,000 crore, 200 crore is the profit that the company has earned. The return, hence the return on investment becomes 20%. Now, the cost of equity is really the expectation of the shareholders of that company that they expect the company to earn. And this is really from the market's perspective. I mean to say share market's perspective. So while investing 1,000 crore in a company, there will be certain form of expectation of a shareholder. So this is called as cost of equity. That expectation is called as cost of equity. This is again, I'm telling from the market perspective. The return on investment is what the company is able to generate. This is the actual return on investment that the company is able to generate. Now, Supposingly, I'm assuming it's 18%. Okay, now let's take this situation. We will take numerous situations here. Okay, students. Yes, Sidalapi, Gunjan, Prashant, Manohar, Gunjan, Srirang, Mamta, Sahu, Kadambari, Bhatt, Anmol, Bhumika. Yes, I think recently all of you have answered. Mostly, I can see your answers are in line with what we are discussing. Okay. Okay. Now, let's take this example. Company is able to give 20% returns. The market is only expecting 18%. So, do you think that company should pay dividend? No. Why? Because company is still earning 2% better. And the company, if more funds are invested in the company, it will earn always 2% higher than what is expected by the shareholder. So shareholder will say that the company, to the company, that company, you keep funds with you and you keep on investing it and you keep on earning 20% on that, because my expectation is only 18%. So whatever you will earn 2% more. You're getting my point? So this kind of things helps in the dividend policy and hence the long-term financing decision. Okay, we will discuss some of these things in detail later on. Okay, in the subsequent part of the session. Then comes wealth maximization decision. So this is, I think, very basic decision or very basic concept where we say that always the wealth has to be maximized of shareholders. Correct? So some of the shareholders will really expect the money to be given now. And hence the wealth maximization principle says that they always will value what you give them today. Okay. Now, let's come to the another topic which says that the relationship between retained earnings and growth. Okay, students. Now let's discuss about something called as retained earnings and growth. Now let's first understand what do we mean by growth. What do we mean by growth? We all say that, growth is essential, but what is the real meaning of growth? And is there a mathematical way to arrive at growth from the company's perspective? Okay. Growth can be in any form, right? So let's try to understand. This is, let's say, year one. The company has earned 100 crores of profit. Then comes year two, and the company has earned 150 crores of profit. The company is growing. Correct? What you will say after hearing this? That in year one, the company had 100 crores of profit. Year two, it has 150 crore of profit. That means the company is growing by 50%. Let's say in year three, the company goes to 220 crore. Again, we will say the company has grown. There is a growth in the company. Yes, Harish. It will let us know that what is the percentage increase in the dividend. Okay. We will come to that. Now, let's say after year three, suddenly there is some abnormality and hence it is again to a level of 125 crore. This is year four. Let's say the sales has not been better. It has gone down. So what I'm trying to say is that while growth is positive, there can be practical situations where it can come down as well. It can be negative also, right? So what do we mean by growth actually? Growth is equal to something that is incremental to the current amount. Correct, students? Something that is incremental to the current amount. So if we are going straight, there is no growth. If we are improving, then there is a growth. And the improvement is the increase in that profits. Now let's understand, how will a company grow? How can we measure the growth of a company? Let's say this box represents earnings for 1 year. Okay. And out of this, let's say I'm splitting it into two parts where I'm saying that this part is getting retained and this part is being paid as dividend. Okay. So something we are retaining and something we are paying as dividend. Let's say this much is being retained and this much is paid as dividend. Now, whatever is retained, again, it will be invested back in the business. Correct? And business is giving us what? Business is giving us ROI, which is this R. Correct? Business using that further investment of this retained amount will give us R. So, what will be growth? Growth will be the incremental amount, right? What is the incremental amount dependent on? The amount retained and the return on this amount retained, correct? With the same level of investment, you will have the same level of numbers. But if you increase the investment, you will get higher profitability. So, incremental income will come how? Whatever we have retained, that we will multiply with the return on investment. Simple. Retained earnings multiplied by ROI will give us incremental income. If I write this in the notations, so this is G is equal to B into R. So this is a formula to remember, students. G is equal to growth. B is equal to retained earnings. And R is equal to return on investments. Yes, Srinivasan, you were right. In the previous example, growth was there, but it was under the decreasing rate. So today, if I want to ask you that how will you calculate growth of a company's profits, what you will do, you will just simply take that whatever they are earning, out of that, how much they are retaining, on that retained amount, what is the ROI that they are generating. If you multiply the retained earnings with the return on investment, you will get growth. Tanishka, retention ratio is the amount retained from the overall earnings. So if I say that E is the total earnings, R is the amount retained, and D is the dividend paid, then retention ratio will be amount retained divided by the overall earnings. Out of the total overall earnings, how much amount we have retained? That is called as retention ratio. Dividend payout ratio will be equal to dividend divided by earnings. Okay. Dividend payout ratio will be dividend divided by earnings. And hence we will call dividend payout ratio plus retention ratio will be 1. Correct? Basavraju, we will discuss the Gordon's growth model and we will link this discussion over there. Srinivasan, we can use ROE or ROCE or ROE in the place of ROI. So ROE we cannot use because it's return on assets. Return on equity or return on capital employed also become different. ROI will be given for the entire business. Okay, Srinivasan, so better to use ROI. Sanya, retained earnings is calculated in percentage or amount to find growth. So this will be in percentage. Retained earnings will be in percentage. So that's what I'm saying. B is equal to retained earnings that are given in the form of retention ratio. We will put that ratio over here and multiply with the returns percentage. And hence the growth will also be denoted in the form of percentage. Okay. I hope till now the discussion is clear, students. Please let me know in case anything is there. Now, let us come to the theories of dividend decisions. So students, there are two kinds of theories. One is irrelevance theory and second is relevance theory. Thank you, Nina, Srinivasan, Bhumika, Tanisha. Okay. Irrelevance theory and relevance theory. Now, students, what is irrelevance theory saying? Irrelevance theory says that whether you pay dividend or you don't pay dividend or you pay some amount of dividend, whatever you do, the value of the firm remains same. There is no impact on the value of the firm. And hence the shareholder is also indifferent whether you paid them dividend or whether you don't pay them dividend. This is actually covered under the approach. Modi, Gilani and Miller approach. Under relevance theory, it says that if you pay dividend, it will have an impact on the share price. It will have an impact on the shareholder's pocket. It will have an impact on the value of the company. So there are two models that we will study here, Walter's model and Gordon's model. Okay. So we will first discuss this, then Walter's model, then Gordon's model. And that will help us in understanding how and what factors do we need to consider while determining whether dividend decisions are, whether dividend to be paid or not under dividend decisions. Okay. Okay, students. Now Srinivasan is saying that, do you think that the market is much efficient? Now, if you see irrelevance theory has a very basic assumption that from the market perspective, it has to be 100% efficient. Then only approach will work. Okay. Now, what is approach, students? Let us try to understand. So it is called as irrelevance theory. Why? Because whatever dividend is paid slash not paid, the value of firm will remain same. Okay. The value of the firm will remain same. So what it is really trying to say? It is trying to say that let's say we are at Y0. Y0 is year 0. Let's say this is the movement of a share price. At Y1, it let's say reaches to 40. And at that point of time, you are declaring a dividend of 5 rupees. So what will happen? The moment you declare a dividend of 5 rupees, the market price will come down to 35 and 5 rupees you will give in the form of cash. So essentially shareholder will still have 40 rupees, correct? 5 rupees in his pocket and 35 worth of that share, which was immediately previous to the dividend of this, which is immediately prior to the declaration of this dividend, which is 40 rupees, right? So do you understand that this theory is trying to tell you that there is no relevance? It is totally irrelevant. Whatever dividend you pay in the form of cash, that shareholder will put it in the funds that shareholders has, and hence before dividend, after dividend, the value that the shareholders have is same. Now let's say on Y1, we will say that before dividend, the 40 rupees value is being held by the shareholder, and after dividend, 35 in the form of shareholding and 5 in the form of cash. So in totality, 40 again. So it is just 5 moved from one pocket to another. Yes, Anmol. Anmol is asking, sir, when dividend is paid, the value of shares got reduced by the amount of dividend paid. Yes, Anmol. It happens. Example of MPS. Mamta. MPS is what? Market price per share. We have some of the questions where we will calculate the market price. Okay. Srinivasan, I don't know what they have won. Okay. So I hope this discussion is clear. So this is the background of approach and hence the irrelevance theory. Okay. Now, under irrelevance theory, let us take this example ahead. Let us take this example ahead. In the first case, I am saying that let's say the firm pays cash dividend using reserves and surplus. So what will happen? The price started from somewhere, reached 40, right? So we are saying that 35 and 5 in totality 40. 5 is cash and 35 is market price. Correct? This is what we understand. Simple. If the firm pays, by firm here I mean the company also, right? It's not only the firm, it means any entity. Okay, Sanya is asking how MPS change. What is the objective of irrelevance theory, Shweta? So, students, first of all, Sanya, to answer your question, what happens? See, why the price of a share changes the moment dividend is declared? We have to understand it from a cum dividend price and ex dividend price. Now, what happens once the price, once the price keeps on increasing just before the dividend is declared, that is called as cum dividend price. That means the dividend is included in the market price. The moment dividend is declared and paid out, that will be paid out from the share value itself, right? Because share value is reflective of the earnings that you have done. Then only the share price is increasing, right? The moment you declare and pay out the dividend, that is called as ex-dividend price. Okay. And hence, whenever there is a dividend paid, there is an impact on the share price. I hope Sanya and Mamta, this is clear, because Mamta also has raised that MPS, you're not able to understand. MPS will decrease. Shweta, what is the objective of irrelevance theory? Shweta, we will understand. Wait, we have not covered the entire theory. We will cover that. Manish, what kind of capital structure those theories are assuming, or capital structure don't have any impact? So Manish, in terms of capital structure, also in my second case, we will see. Okay, capital structure, the companies, it is assumed that they will borrow whatever is the additional need. For whatever investment is needed, they will borrow. Okay. Perfect. Now let's come to the second part, where we say that the firm pays dividend in cash using new equity shares. So the company is actually issuing new equity shares for the purpose of paying dividend. Now, please don't ask me that whether legally it is possible or not, but this is part of the theory. The MM theory. MM theory assumes that whatever is the fund's requirement, it will have to be taken through the issuance of equity shares. So what you will do, issue new equity shares. That means you will raise the funds. Then step number 2 will be cash collected. Once cash is collected, then company will pay dividend using that cash. That is the step number 3. Yes, Gunjan. Gunjan is asking, share price is decreased by whatever ex-dividend price. Yes, share price will reach to a level which is called as ex-dividend. So this 40 is called as cum dividend and 35 is called as ex-dividend in my previous example. Okay. Yes, we were here. So what happens to the shareholders? Students, First, there is a share price that is there. Then they get dividend. Whatever dividend that they get, they also have a valuation loss. This valuation loss happens because of the dilution. I will explain you through proper example. Okay. This dilution happens because they are issuing new equity shares to collect some cash so that the company pays dividend. At an overall level, shareholders' value will not change. Okay. And then the third case in this example is that the firm does not pay dividend. In such a case, the price is 40 and it will remain 40. There is no change in the price. Now, students, let us try to understand all this theory with the help of one example. Okay. Now, I request everyone to please focus here. Sahu, I'm re-explaining the approach through this example. And we will be able to understand it better through this example. Okay. Now, let's say there are 2 lakhs worth of equity shares that are issued, and they are issued at 10 rupees per share. Okay. 2 lakhs equity shares have been issued, and the price at which they have been issued is 10 rupees per share. So there is no borrowing. All reserves and surplus is invested in capital investments. So I hope there was a question from Manish. What kind of capital structure? So this is the capital structure that approach assumes. So that there is no borrowing. All the reserves and surplus keeps on getting invested in the capital investment. The cost of capital, which is also called as KE, that we discussed, is 10%. Yes, Anirudh, cum dividend is higher from ex dividend because cum dividend includes dividend, ex dividend excludes dividend. Now, using this information, we will ascertain the approach irrelevance theory. Now, first of all, we have to calculate the market price. So students, step 1 is to calculate the market price. Market price at the end of 1 year. At the end of 1 year will be given by price at the beginning multiplied by 1 plus cost of equity, 1 plus cost of equity minus dividend at first year. So students, please remember this formula. So P1 is equal to price at the end of year 1. P0 is equal to price at the beginning of year 1. KE is equal to cost of equity. From our previous discussion, what is this cost of equity? Cost of equity is the return expected by the shareholders. D1 is equal to dividend expected to be paid at end of year 1. Okay. So first step is to calculate the market price. In our example, we have to prove irrelevance theory, right? So we have to take 2 cases, case number 1 and case number 2. So case number 1, we are saying that the company does not pay dividend. So in such case, the market price will be 10 rupees, which is the current share price, 1 plus 10%, which is the cost of equity, minus 0. Dividend is 0, right? We are assuming that dividend to be paid is 0. So 10 into 1.1, which is 11 rupees. So P1 becomes 11. And the value of company becomes 11 into 2 lakh shares, which is 22 lakh rupees. I hope clear till now, students. This is clear, students, till now. Now, let's take case 2. So case 1, we have assumed that the company does not pay dividend. Case 2, let's assume company pay dividend using new equity capital issued. Okay. Perfect. So before we calculate the new number of shares to be issued, we have to calculate what is the price of the equity share after year 1. So again, P1 is equal to 10, 1 plus 10% minus what is the dividend? Let's assume that dividend per share that we are going to pay is rupees 3 per share. Okay, so this is additional information that is given. So 3 per share is dividend that we are planning to pay. So minus 3. Mamta, 2 lakhs are the number of shares. In my example, if you see 2 lakhs equity shares. So that is what I have taken here, 2 lakhs. Okay. Manohar is asking, why are we subtracting dividend? Manohar, as just now I have discussed, cum dividend price, ex dividend price. The moment you pay dividend, your price goes down by the same amount. Hence, we are reducing dividend from this formula to arrive at the correct price after dividend is paid. If no dividend is paid, nothing will be reduced. Okay. That's what we have just discussed. Now, here it comes. P1 is equal to 11 minus 3, which is equal to 8. Parthsarthi, please check again. It's not 7.11, it will be 8. So the price will be 8 rupees in case we are planning to pay dividend by issuing new equity shares. Now, we have to calculate how many number of new equity shares to be issued. 2 lakhs into 3 rupees divided by 8. So 2 lakhs are the number of shares, 3 rupees is the dividend. Total amount we need is 6 lakh rupees. And 8 rupees is the current price that we have calculated using this formula. So that means the number of shares to be issued is 75,000. Okay. And hence the value of company will become how much? 2 lakhs are the existing shares. 75,000 are the new shares multiplied by 8 rupees. Okay. Okay, students. So this becomes 8 into 2,75,000, which is equal to 22 lakhs. Again, the value of company will be 22 lakhs. So students, if you see, if we have not paid dividend, what was that value? 22 lakhs. In case 2, if we have paid dividend, what is the value? 22 lakhs. This is what the irrelevance theory approach trying to tell you. Parsarthi, yes, 8. Perfect. Manohar is asking, if we add cost of equity and it is like dividend, again, why we subtract? Now, wait. Manohar, please don't confuse cost of equity with dividend. I am telling you that this cost of equity, okay, let me go to the formula. This cost of equity is actually the expectation of the shareholder in the form of dividend and also in the form of capital appreciation. If the cost of equity is 18%, it means that a shareholder expects that the value of the share price should go up by 18% from year 1 to year 2. Now, in the next year, the company decides to pay out of that increase some dividend. So what will be the price after that dividend? I will just reduce that dividend from the higher price. And hence, this formula of P1 is equal to P01 plus KE minus D1. Okay. Yeah. So using this equation, P1 is equal to P0, 1 plus KE minus D1. P1 plus D1 is equal to P0, 1 plus KE. Correct? And P0 is equal to P1 plus D1 divided by 1 plus KE. So Sanya is asking, why will company issue new equity shares? Why? Because theory assumes that the basic assumption of theory is that the company will issue new equity shares. Gunjan is asking, but sir, if pay cash in dividend, then value of the company will go down. Yes, you're right, but we are issuing new equity shares also, Gunjan, to cover up that value. If we pay dividend, the value will go down, but for paying the dividend, we are again issuing the shares in the market so that the value will remain same. That is what the irrelevant theory is also telling you. Okay. Now, the value of firm, or using the above formula, I am writing N into P0. Okay. Because the numbers into the current price will give me the value of the firm, right? As on today is equal to N plus delta N P1 minus investment plus earnings divided by 1 plus cost of equity. Students, you have to remember this formula. Muskan is saying, can we do it with case 3, sir? What is the case 3? You tell me, Muskan. There is no case 3. Either we pay dividend or we don't pay dividend. If we pay dividend at 3, this is the amount. Case 3 can be if we pay dividend at the rate of 4 per share, then what is the amount? Still, it will be the same. You try it. Okay, you try it. It will come as same. If you pay 4 rupees dividend, the value will be 22 lakhs again. So I am rewriting this equation. Value of the firm will be N plus delta N, price at the year end minus investment plus earnings divided by 1 plus KE. Now here VF, value of the company today. So this is very important, students. This is the value of the company as on today, because we have divided by 1 plus KE. That means we are calculating the present value. Okay, so this is as on today, what is the value of the company? N is equal to the original number of equity shares. Delta N is equal to new number of equity shares issued. E is equal to earnings that we are holding in the form of that company, right? Earnings for the year. I is equal to investment required by the company. And finally, KE is cost of equity. Yes, Manish. So Rajneesh is asking what is the meaning of delta N? Yes, Rajneesh. So delta N is the new number of shares that has been issued. In our previous example, it is 75,000 shares. Okay. In our previous example, we have said that 75,000 is the new number of shares, that is delta N. Sanya, not subtracted dividend because dividend is already subtracted in P1. That's why. Okay. I hope this is clear, students, till now. Let's do one thing. Let's do question number 1. Along with that, the approach will be 100% understood. Okay. Now, question number 1 says AB Engineering Limited belongs to a risk class for which the capitalization rate is 10%. Capitalization rate is 10% means KE is equal to 10%. Okay. It currently has outstanding 10,000 shares selling at rupees 100 each. Current market price is 100. Number of shares are 10,000. The firm is contemplating the declaration of a dividend of rupees 5 per share at the end of the current financial year. Okay. It expects to have a net income of rupees 1 lakh and has a proposal for making a new investment of rupees 2 lakh. Calculate the value of the firms when dividends are not paid and dividends are paid. There are two cases. They have given us investments, they have given us earnings, they have given us the cost of equity, they have given us everything that we have to use. Okay. Srinivasan, we need not take WAC. We only need to take KE because we are talking about the equity here. In the entire theory, there is no talking on debt. Okay. Gajendra, case 3, the company will pay dividend from reserves. Then also the answer will become same because in approach, it is assumed that the reserves will also be utilized for the purposes of investment. Okay, Gajendra. So in this case, Gajendra, we have reserves, okay, and we have investments. So let us try to understand from this question. Okay, from this, your doubt will be cleared. Let's see. So first of all, students, let's take the case where dividends are not paid. In case dividends are not paid. Okay. So for that, we have to calculate the P1. P1 is equal to P0, 1 plus KE minus D1. Correct? P1 is equal to 100. 1 plus 10% minus dividend is 0. In the first case, dividends are not paid, right? So it will be 0. So hence the P1 becomes 110. P1 becomes 110 students. 100 plus 10%. Okay. Yes. Then step 2. So let's do a step by step working, right? So this is step 1. Step 2 is calculation of funds requirement. So students, what is the investments funds required? 2 lakh rupees. Yes, Bhumika, your answer is correct. From this, we will be able to fund basis our earnings as 1 lakh rupees. So net, we need net funds required is equal to 1 lakh plus what funds you need for dividend? Nil. In this case, we are assuming we are not paying any dividend, right? So we need nil for dividend. So 1 lakh rupees is the net amount required. Then comes step 3. Calculation of number of new equity shares to be issued. So number of shares will be 1 lakh rupees is the net amount required divided by 110. Simple. I will leave it here only. I will not calculate it further because in the formula, if I put it, it will get solved. Okay, I'm not solving this unnecessary. There will be some decimals. Then step number 4. So step number 4 is calculation of value of firm. So the value of firm is equal to, let's first write the formula n plus delta n P1 minus I plus E divided by 1 plus KE. So hence the value of firm becomes, what are the number of shares? 10,000, right? So 10,000 plus new number of shares are how much? 1 lakh divided by 110 into P1. P1 is what? P1 we have already calculated is 110. So the reason why I have not calculated this is because 110 will get knocked off from this. Okay. So hence when the bracket opens, it will automatically be calculated. Minus 2 lakh is the investment plus 1 lakh is the earnings, right? As per our formula, whole divided by 1 plus 10%. So if you solve this, then the value of firm becomes 10 lakhs. And again, as on today, this we are saying this is as on today. The value of firm is as on today, students. Clear, students, till now? So there are 4 steps. In the first case, we are saying that the dividends are not paid, and there are 4 steps. The step 1 is calculation of the price. We will use this formula. Then step 2, calculation of the funds requirement. We will take into account what is the investment plan. We will take into account what earnings we have done, and we will also take into account what dividends we have to pay. Basis that we arrive at the net amount required. Step number 3, we calculate the new number of equity shares to be issued, which is delta N. This is actually delta N, correct? Then step number 4, we calculate the value of firm. Now let's take case number 2, where dividends are paid. At the rate, what is the dividend payment at the rate? At the rate 5 rupees per share. Nikita, sir, can you the value of the firm calculation, the calculator? You're not getting 10 lakhs. Okay, we can see. See, if you solve this, what will be there is, it is 10,000 multiplied by 110 minus 1 lakh. It will become 1 lakh, correct? Because this will get cancelled and this 110 will get multiplied here, right? So this minus 1 lakh 2 plus 1 lakh. So this plus 1 lakh minus 1 lakh will get cancelled. And finally, we will divide it by 1 plus 10%, correct? I hope you're there with me. Now, if you solve this, it will become 11 lakh. 11 lakh. Sorry, 10 lakh into, sorry, 10,000 into 110. Yes, 11 lakh, correct? 11 lakh minus, wait, something wrong I have did. 110, 10,000 into 110 plus 1 lakh minus 2 lakh plus 1 lakh. Sorry, this is plus 1 lakh actually. Wait. So this is plus 1 lakh. So what will happen is this plus 1 lakh, this plus 1 lakh will get cancelled with this 2 lakh, right? So ultimately we are left with 11 lakh in the numerator. Now 11 lakh divided by 1.10. This is actually 10 lakhs. Okay, Nikita? If dividends are not paid, why are shares issued and why are funds required? Sanya, because this theory assumes that there will be a still minimum investment that you will need. That's why the shares are being issued. Okay. Now, please focus here. When the dividends are paid at the rate 5 rupees per share. Step 1. Calculation of value of share, right? P1 is equal to 100. 1 plus 10% minus 5. So this time minus 5 will happen because of the dividend. Okay. So P1 becomes 105, students. Step 2 will be funds requirements. Funds requirements, how it will be done is investments, first of all, is 2 lakhs minus earnings is 1 lakhs plus dividend. 10,000 shares multiplied by 5 per share. 50,000 rupees is the dividend needed. For that also we need the funds. So it will get added to the funds requirement. And hence the net funds requirement is 1,50,000. net funds required is equal to 1,50,000. So step 2 is done. Step 1 and 2 is done. Then let's come to step number 3. Number of shares. 1,50,000 divided by 105. Again, I am not calculating this, okay? Because this I will use in the formula. Next step. Number of shares are calculated. So you need a total amount of 1,50,000. And from the market, you need to raise the new equity shares. The market price is appearing to be 105. So you will raise 150 divided by 105 as the new number of shares. Step number 4 will be the value is 10,000 plus 1,50,000 divided by 105 multiplied by 105 minus 2 lakh plus 1 lakh. This whole divided by 1 plus 10%. Sahil, that is not actually 11 lakh minus 2 lakh. That was wrong. What I was saying is this was plus actually. So plus 1 lakh will get, and this plus 1 lakh, this plus 1 lakh will get reduced from this minus 2 lakh. That will get cancelled. Ultimately, what we will be left with is this. Okay. Now let's solve this. 10,000 into 105 plus 1,50,000 divided by 105 into 105 minus 2 lakhs plus 1 lakhs whole divided by 1 plus 10%. So if we further solve this, this is getting negated. So 1,50,000 plus 1 lakh is 2,50,000 minus 2 lakh is 50,000. So ultimately this will become 10,50,000 plus 50,000 from here whole divided by 1.10, which is again 11 lakh divided by 1.1. So the value of firm again here becomes 10 lakhs. So it is proved that whether we pay, yes, Harish, same answer. Pooja, thanks. This is the correct answer, 10 lakh. So whether we pay dividend or whether we not pay any dividend, the value of the firm, again, I am remembering this is as on today because we have already taken it as a present value. Okay. So the value of the firm remains same. That is what the irrelevance theory suggests. Now, see. First case, we have taken no dividend. Second case, we have taken yes dividend. In case of no dividend, the market price per share was 110, correct? In case of yes dividend, the market price per share was 105. The value of the firm 10 lakhs, and here also the value of the firm was 10 lakhs. Okay, students. I hope till now all of us are clear on the irrelevance theory. It is very simple and it's a very stepwise approach to calculate the irrelevance theory solution. Step 1, market price, which will take into account whether you are paying dividend or not. Step 2, calculation of the funds requirement, because apart from the earnings that you are making, you also have an investment requirement. And in case you are paying dividend, you will add dividend. Third step is to calculate the number of new shares to be issued at the revised share price. And finally, arrive at the value of the firm using that simple formula. Okay, students? So students, I suggest let's take 10 minutes break. It's 7:26 right now. Let's again reconvene at 7:36. So welcome back, students. Before the break, we were discussing on the irrelevance theory, which is the approach. Just a second. So Mamta was asking, in reality, when dividend is paid, the price is reduced. Yes, in reality, it happens. Once the record date is announced for dividend and the dividend amount is also announced, after that record date, up to that record date, the price increases. After that record date, the price decreases. Okay. Now, let's come to the second theory, students. This is also an interesting one. Now we are talking about the relevance theory. Relevance theory, we have Walter's model. Okay. Now to understand Walter's model, we have to understand this formula, which is P is equal to D divided by KE. Correct? So price is equal to dividend divided by cost of equity. Now dividend is just a basic dividend. So tell me, students, whether the price will be only reflective of dividend or whether it will also include something else. So this is the current dividend and we are dividing it by the expectation to arrive at the price. But apart from this, something else will also be added to arrive at the price. What will be that something else? This is the earnings minus dividend, which is the retention amount. Earnings minus dividend is the retention amount multiplied by R divided by KE. This whole divided by KE. Yes, very good, Harish, Sanya, Manish. Very good. Retained earnings. Very nice. So one is the price will be reflective of whatever dividend you are paying and dividing it by the cost of equity. However, there is some amount that you are retaining. This amount you have retained, on that you will earn R. That will be taken at a value of KE. This whole divided by KE, which is to arrive at the futuristic amount at a present value. Yes, capital appreciation. This is the capital appreciation led amounts. So if we rewrite this, the amount becomes price will be dividend plus earnings minus dividend into R divided by KE whole divided by KE. This becomes the price. So P is equal to price of the share. R is equal to rate of return. KE is equal to cost of capital. E will be earnings. And D is equal to dividend. Correct? So the price of the share can be computed as by adding the dividend and the future earnings in the form of E minus D into R divided by KE. And then whole of that amount will be divided by KE to arrive at the price of the share. This is what the Walter model says. Clear, students? Now, this is very interesting part that we are going to discuss now is the relationship between dividend and market price per share. So there is a relationship that is driven between the dividend per share and market price per share, where we say that if R is equal to rate of return or return on investment, which means the actual return that the company is earning that we have already discussed, and KE is the cost of equity. Correct. This is the expectation from the shareholders' perspective. This is what the market expects. Scenarios. Relationship between dividend and market price per share, and finally dividend payout. So let's come to the scenarios. So scenario one is the growth case. Growth case means that the company is in a growing mode, wherein we say that R is greater than KE. The previous example that I have told you, R was 20%, cost of equity was 18%. Correct. So in that case, what was happening? The shareholders will prefer the amounts to be kept with the company, invested with the company, so that they earn good amount of returns, right? So in this case, what will be the dividend policy? Dividend payout will be 0 and the relationship between dividend and MPS will be negative. Higher you pay dividend, lower your MPS will become. Correct? Because R is greater than KE and hence the amount should stay invested within the company. Yes, Manish. Not only Walter, but everyone assumes that the firm has a perpetual life. Then only valuation is possible. Otherwise, valuation is not possible. Okay. Then, constant case, wherein R is equal to KE. Here, dividend can be paid in any ratio because it is indifferent. Whatever shareholders are expecting, the company is giving them. Now, shareholders are okay if the company keeps the money with them or pays it to them, right? So there is no correlation. So there is no relationship between dividend and MPS. Whatever dividend you pay, MPS will not have any impact. Then comes declining case where R is less than KE. So R is, let's say, 18% and cost of equity is 20%. Shareholders expect 20%, but the company is able to deliver only 18%. Now, what shareholders will say? Shareholders will say that better you give us our money back in the form of dividend. I will invest it at another place where I'm getting 20% because my expectation is 20%. I would not want the funds to be invested with the company because the company is giving me 2% less. So here, there will be a positive correlation. Higher dividend, higher MPS. If I pay higher dividend, my market price per share will also become higher. And in this case, the dividend payout ratio should be 100%. I hope this is clear, students. This is a very important relationship because most of the questions are based on such relationships. Clear, students? Any questions till now? So we have covered irrelevance theory, Modi-Gilani and Miller approach. We have covered Walter's model, wherein we have studied about the relevance theory. Relevance theory, what does it say? Is whether you pay dividend or whether you not pay dividend, it will have an impact on the value of the firm. That means it will have an impact on the market price per share. Using these three scenarios, growth case, constant case, and declining case, we are able to understand what is that impact will be and what should be our approach in these three different cases. Okay, Anmol, I am explaining this table again. So Sani is saying dividend will reduce MPS. I am still agreeing with you. Dividend will reduce MPS. But it has to be seen in the correlation of R and KE, Sanya. So yes, cum dividend and ex dividend, that relationship will definitely hold. Okay. But the R and KE will also have a significant role to play. We will understand it from the questions. So Anmol is saying to explain this again. Let me explain this table again. So please hear me out. Here we're talking about the relationship between dividend and market price per share. For that, we are saying we have to always compare R and KE. I think R and KE, we are clear. Now, if there can only be three cases where R is greater than KE, R is equal to KE, and R is lesser than KE. Where R is greater than KE, then the relationship between dividend and MPS is negative. Because the firm is helping to get a return of a higher amount compared to what the expectation is, and hence the dividend payout is zero. This becomes negative. So shareholders will say that you don't pay any dividend, you keep it with you and invest it. In case you pay dividend, it will be a negative impact on the MPS. In case of a constant case, there is no correlation. Whatever you want to pay, you pay. It will not have any impact because whether you keep or whether you pay to shareholders, it will not have any impact because R is equal to KE. In case of a declining firm where the return is less than what the shareholders expect, then shareholders will say that whatever you are earning, you give it to us, because if you reinvest that amount, you will earn at a lower rate. And our expectation is higher, and hence we would want 100% to be paid as dividend. Okay. Yes, Sanya, we will understand from the questions. We have enough questions on declining growth and constant cases. Okay. There I will tell you this in further detail. Now let's come to question number 2, students. XYZ Limited earns rupees 10 per share. So this is the earnings that they have given to us. Capitalization rate and return on investments are 10% and 12%. So capitalization rate is KE and return on investment is R, which is 12%. Determine the optimum dividend payout ratio and the price of the share at that payout. Now, students, this is very easy. KE is equal to 10%. R is equal to 12%. R is greater than KE. What do you want to be decided for an optimum dividend payout ratio? Tell me, students, come on. What should be my dividend payout ratio? Whether it should be 0, it should be 100%, or it can be any ratio. Tell me, students. We have been given that the firm is able to generate 12%. The expectation of shareholders is only 10%. What will be the optimum dividend payout ratio in this particular case? Yes, students, please answer. The optimum dividend payout ratio would be very nice. I'm getting wow, wonderful. Every one of you is right. Anmol, Sanya, Mansi, Bhumika, Harmisha, Manish, Pooja, Srinivasan, Kanupardi, Jishnu, Shweta, Harish, Shetlapalli, Sumesh, Sanya, Ninad, yes, should be 0. Very nice, students. Easy and understood. So the price at this will be using the Walters model. What is the Walters model formula? E minus D R divided by KE whole divided by KE. So let's put the numbers in the formula. P is equal to dividend is 0. That is what we have decided. This is the optimum dividend payout ratio. 10 minus 0. Earnings is how much? 10 rupees. The question has given us. Sorry, where is the question? Yes. Here it is given. 10 rupees per share. So this becomes 12% divided by 10% whole divided by 10%. So 10 into 12 divided by 10, that means 12 divided by 10, it becomes 120 rupees. So the price at the optimum dividend payout ratio becomes 120 rupees, students. Okay, I hope this is clear. Very good. Harmisha, answer is correct. 120. Let's come to question number 3. Question number 3, students. It says that the following figures are collected from the annual report of XYZ Limited. Yes, Shweta, your answer is correct. Net profit is given 30 lakhs. Outstanding 12%. Preference shares is given as 100 lakhs. Number of equity shares is 3 lakhs. Return on investment and KE is also given. R and KE. Compute the approximate dividend payout ratio so as to keep the share price at rupees 42 by using Walters model. We have to use Walters model and we have to calculate a payout ratio. This is a bit different question, students, because we have been given the price and we have to calculate the share. Sorry, we have to calculate the dividend payout ratio. So first of all, we have to put down the formula to understand what is required and what is given to us. So if you see KE is given, R is given, and earnings we have to compute. And this price is also given, which is 42 rupees. Okay. So let's do one thing. Let's first of all compute the earnings. Earnings per share. What are they? Net profit is 30 lakhs. Correct? This is what is given in the question. 30 lakhs is the net profit. Now, here earnings will mean the earnings attributable to the equity shareholders. Correct? In this case, there is a preference capital also issued. And preference shareholders have a preference on dividends to be carved out from those earnings. Correct? So this becomes 100 lakhs into 12%. This becomes 12 lakhs. Correct? 100 lakhs into 12%. 12% is the rate at which these have been issued and 100 lakhs is the amount of the capital. So this becomes 18 lakhs earnings for equity shareholders. divided by number of shares. How many number of shares are given? 3 lakhs. This is again given in the question. 3 lakhs is the number of shares and hence EPS comes as 6 per share. 18 lakhs divided by 3 lakhs. Yes, Shweta, your answer is correct. 18 lakhs. Pooja, your answer is correct. 6 per share, Pooja. It's not 6 lakhs, it is 6 per share. Earnings total is 18 lakhs. 3 lakhs are the number of share. Earnings per share becomes 6 per share. Now, again coming back to the formula. Now let's substitute the numbers. Price, which is 42 rupees, is equal to dividend plus earnings minus dividend multiplied by 20% is R divided by 16%, which is KE, whole divided by 16%. Sanya, where are you saying divided 3.12? We have to divide it by 3 lakhs, right? And hence we arrive at 6 per share. Now, oh, sorry. Sanya, you have given the answer, I think. So let's find out the D from this equation. D is actually 3.12 per share. So yes, Sanya, your answer is correct. 3.12 per share is the dividend value. So the dividend payout ratio becomes 3.12 divided by 6 into 100. So this is 52%. Yes, dividends, Sanya. I understood. Harmisha, your answer is correct. So if they follow a dividend payout ratio of 52%, they will arrive at the price of 42 rupees. Clear, students? Tell me, clear, everyone? Or should we? So Walter's model is clear? Harmisha, crystal clear. Srinivasan, yes. Sahil, yes. Shweta, yes. Perfect. Bhumika, your answer is correct. 52%. Now let's come to the third model. Gordon's model. Again, this is part of the relevance theory. Mamta, Shweta. Okay, thank you. Yes. So here also we have to understand a formula. Simple. So Gordon's model said that the relevance is of dividend, correct? So we have to really understand that how much dividend are we paying and what are the growth potentials. So what Gordon suggested is that the price is reflective of earnings that you are supposed to make multiplied by the amount of payout that you are expecting to do, which is 1 minus B. B is the retention ratio. whole divided by KE minus B into R. We see this. So this becomes KE minus BR is equal to E1 1 minus B divided by P0, right? And hence cost of equity becomes E1 1 minus B divided by P0 plus B into R. B into R was what? Growth. Students, remember, growth was BR, right? Please don't forget this. Now see, let's try to understand this equation and this equation. Okay? Both of them are derived from one another, right? So here in the let's first understand the equation number 2. Equation number 2 is saying the expectation that a shareholder will have is of two things. One is dividend and second one is the growth. Why growth? Because the moment you are saying that there will be some dividend, there will be some retained earnings also. Those retained earnings will be invested at some rate. So hence, they will also expect some growth. So this is growth. And even 1 minus B is actually the dividend equivalent amount. Correct. Divided by the price will give them the percentage. Correct. That is why we are dividing by the price to arrive at the percentage. So this is what the realistic expectation of a shareholder will be. That is denoted by KE. Hence, the above formula rewritten is P is equal to E1 1 minus B KE minus BR, which is this. Okay. And if you want to read out this, so this will say whatever you are expecting to earn, and from that, whatever you are expecting to do a payout, that payout in the form of cash flow will be divided by your expectations minus what growth we are already giving to you. Okay. Okay, students. So I hope this is clear. Gordon's model. We can use both the formulas, both these equations, sorry, interchangeably, right? Because both of them represents each other. Okay. So P0 is equal to E 1 minus B divided by KE minus B into R. So P0 is equal to the price of the share. E is equal to earnings per share. B is equal to retention ratio. One minus B is equal to dividend payout ratio, correct? If B is the amount that is getting retained, 1 minus B is the dividend payout ratio. So Sanya is saying instead of 1 minus B can be multiplied by D. Yes, you can multiply it by dividend payout ratio. So B is actually ratio. So if you don't want to multiply 1 minus B, then multiply it with the dividend payout ratio. That's what I'm trying to explain here. KE is equal to cost of capital. B into R is actually the growth rate. That's all right. And needless to say, students, always remember the dividend payout in these three cases that we have discussed. Growth ones, where R is greater than KE, it will be 0. In case of constants, where R is equal to KE, it is any ratio. And for the declining ones, where R is less than KE, it is always 100%, the dividend payout ratio. I hope the Gordon's model is also clear. So students, if you see, Gordon's model actually takes into account the growth as a perpetual subject, and it says that growth is inherent in the expectation that a shareholder has. Hence, whatever cash flow company is expecting to pay in the form of dividend, that has to be divided by the difference between the expectation minus the growth. Anmol is saying of which 100%, in case R is less than KE, it will be 100% Anmol. We have discussed that table again, right? While discussing the Walters model, we have discussed that table. In that we said it will be 100%. I hope this is clear, students, till now. Let's move ahead. Question number 4. Question number 4. The following figures are collected from the annual report of XYZ Limited. The net profits are given as 30 lakhs. Outstanding 12% shares is given as 100 lakhs. Number of equity shares is given as 3 lakhs. Return on investment is 20% and cost of equity, that is KE, is 16%. Calculate the price per share using Gordon's model when dividend payout ratio is 25, 50, and 100%. Three cases they have given us the dividend payout ratio, and we have to calculate the price using the Gordon's model. So students, first of all, what is the Gordon's model? P0 is equal to E 1 minus B divided by KE into B into R. Correct? So let's calculate for all these three cases. First of all, what is B? What is 1 minus B? Right? What is B? B is the retention ratio. Correct? B is actually retention ratio. So here we have taken cases 1, 2, and 3. All these three cases that we have taken. For them, the retention ratio in first case will be, if I'm paying a dividend of 25%, how much I will retain? Obviously, 75%. In the second case, if I'm paying 20%, how much I will retain? Balance 50%. In the third case, if I'm paying 100%, how much I will retain? 0%. Yes, Anmol, you're right. Similarly, 1 minus B will be stated as payout ratio, correct? So first case, 25%, 50%, and 100%. So 1 minus B is clear and B is also clear. Perfect. Yes, Anmol, you're right. Shweta, your answer is correct. Perfect. Then next step will be calculation of earnings per share. So how we calculate earnings per share? We have net profits. How much? 30 lakhs minus preference dividend. For the same logic that we did in the previous question, that the profits has to be taken after reducing the preference dividend. That is for the earnings attributable for the equity shareholders. How much is the preference dividend? 100 lakhs multiplied by 12%. 12 lakhs will go for a reduction. Divided by number of equity shares, which is 3 lakhs, and hence the earnings per share becomes 6 rupees per share. I think the numbers are totally same with from the previous question. The numbers are 100% same for the EPS, correct? Shweta, NP minus preference dividend 18 lakh. Yes, you're right, Shweta. Your answer is correct. So earnings per share becomes 6 per share. Now we have to substitute in the formula and calculate what? Calculate the price. So the first one, when dividend payout ratio is 25%, then price is equal to earnings. Earnings is how much? 6. 1 minus B is what? When the dividend payout ratio is 25%, then 1 minus B is actually 25%, right? But 1 minus 75% will give us 25% divided by 16% is the cost of equity. 20% is the return, right? So 16% is the cost of equity minus 50% into 20%, which is, sorry, I did something wrong here. Minus B into R is what we have to do, right? So what is B? 75% into R is 20%. Yes, Sanya and Sahil, your answer is correct. This becomes 150. So the price today becomes 150. Second, when dividend payout ratio is, yes, Chelapati, your answer is correct. 50%. Then price will be 6 rupees multiplied by 1 minus 50% whole divided by 16% minus 50% into 20%, which is 50 rupees. Third, then dividend payout ratio is actually 100%. Then in that case, price will become 6 rupees, 1 minus 0%, correct? B becomes 0 then in that case, because we will pay everything out. 16% minus 0% into 20%, which will be 37.50 rupees. Very good. Bhumika, answer is correct. Okay. Now let us plot this. The dividend payout ratio was how much? 25%, 50%, and 100% in third case, right? 25, 50, and 100. So the prices are 150, 50, and 37.5. 150, 50, and 37.50. These are the prices. This is the DP ratio. Correct, friends? Yes, Harmisha. Now your answer is correct. 37.5. Now, can anyone tell me any sequence or logic in this? We have understood R is equal to 20%. KE is equal to 16%. Using this information, can you tell me what is the optimum dividend payout ratio? Kyle is saying what is heuristic model? Harish, we can say that when the growth rate is higher than cost of equity, the price will be high. No, Harish, we can't really say that. So let's first focus on what I'm asking. Then I think most of your answers will be there. Yes, Chetlapalli is saying 0. Sane is also saying 0. Correct, because in this case, I would want all the funds to be invested at the rate of 20% because my expectation as a shareholder is only 16%. Okay, so my optimum dividend payout ratio will be 0. That is what the theory says. And at this price, at this optimum dividend payout ratio of 0%, the price should be highest. Correct? So if you see, if I'm reducing my dividend payout ratio, my price is actually increasing. So at 25%, it is at 150. Can we compute the price at a dividend payout ratio of 0%, which is actually the optimum ratio? This is the optimum ratio, right? Yes, very good. Sanya, Shweta, Pooja, every one of you are saying is 0. Perfect. Now, this DP ratio, if it is 0% and the optimum is this, then B becomes 100%, right? Retention ratio becomes 100%. So the price becomes 6 rupees is the earnings. 1 minus 100%. Correct? Divided by 16% minus 0. Sorry, this will be 100% into 20%. Correct? However, we cannot solve this, right? Because this will give us 0. But what I'm trying to say is that since your DP ratio becomes 0, right? So the dividend payout ratio becomes 0. Effectively, whatever you are earning, you will keep on reinvesting it at 20%. And hence, your price will be maximum in that particular case. Okay. So let's say this formula is not giving us anything, but using Walter's model in our previous question, we have calculated this, correct? No, actually in this also we have not calculated because it was given that it should be 42, correct? It should be 42. That is what it was given. But let's say using Walter's model, we calculate this price. So the price is equal to dividend plus earnings minus dividend R divided by KE whole divided by KE. This is a Walter's model. So the price is equal to dividend becomes 0 in this case plus earnings of 6 rupees multiplied by 20% divided by 16% whole divided by 16%. If we do this, then what we get? Wait, it's 20 divided by 16, right? So if we do this, what is the price that we really get? 6 into 0.2 divided by 0.16 divided by 0.16. Is there something wrong that we did? Wait, actually, we cannot use even Walter's model to compare both the Gordon's and Walter's model because both of them have different formulas altogether, right? So in a way, I mean, students, I request all of you to please ignore this calculation, right? Because the above calculations has been done basis the Gordon's model, right? Yes, Sanya, Bhumika, Shweta, all of your answer is correct. Although I am requesting that please ignore the Walters model for the time being because these numbers of 150, 50, and 37.5 has been calculated basis the Gordon's model. And hence, directionally, our theory is proved from this dividend payout ratio being reduced and the price being increased. I think that is what we will have to understand from this part. Okay. Okay, students. We have kept the things simple. Let's not overcomplicate the things. The lower the DP ratio because it's a growing firm, higher the price will be. Okay. Now, I think the last concept for today's session is actually the Gordon's revised model. Gordon's model, this is based on the bird in hand theory. What is bird in hand theory saying is today's dividend will have a higher value compared to future dividend that you are expecting to pay. So investor prefers today's certainty over yes, as AP DP ratio decreases, price increases, but Bhumika, that will happen where R is greater than KE in that case, okay? Over future uncertainty, okay? So here price, the revised formula is dividend 1 plus growth divided by KE minus G. So here the formula has been substituted rather than using the earnings. 1 minus B, it has been substituted by dividend 1 plus growth divided by KE minus G. It can also be rewritten as D1 divided by KE minus G. No, Sanya, that's what I'm saying. Let's not solve it beyond, what is given in the facts of the question. Okay. It's only to show us a trend. That's all. Bhumika, okay. So this is clear where we are saying that P0 is equal to the price as on today. D0 is equal to dividend current year, or sometimes question says last year. We will take it as current year or last year both. G is equal to the growth rate and KE is equal to the cost of equity. Okay, so this is the formula for birds in hand theory. This is the revised Gordon's model, which makes use of dividend rather than earnings into 1 minus B. Okay, students. So just to sum up today's discussion, students, we have studied what is the relevance of the dividend decisions in the entire financial management. We said that there are different decisions. One is financial decision, investment decision, and dividend decision. Why dividend decision is important? Because the long-term financing is dependent on the dividend decisions. And there are two theories for dividends. One is the irrelevance theory, which is complete, which is M&M approach, Modi, Gilani, and Miller approach, which says that whatever dividend you pay, it will not have any impact on the value of the firm. Then we studied about the relevance theory, which said that whether you pay higher dividend or lower dividend, it is actually an outcome of R and KE. If you're internally you're able to generate higher return than your expectation of the shareholders, it's better to keep amounts with you invested and not to pay any dividend. And hence dividend payout ratio should be 0. So in this relevance theory, students, we have studied about two models. One is the Walters model and second is the Gordon's model. Gordon's model also we have studied two formulas. One is the original formula and second is the revised Gordon's model, which is also called as the bird in hand theory. So students, we will conclude our session today on this. We will complete the balance part and the questions in the next session. Till then, please do revise well and let's catch up in the next session. Thank you, students. Good night.